Well, we got a Q&A session with John Stillman today. We got three good questions, three scenarios that maybe you'll come across at some point. We're going to talk about getting a raise at work. What do you do with the money to make sure you're using it responsibly? What about giving your adult children a gift without getting hit with a tax penalty? And then also Social Security, the age-old question. When should you start it? Well, this one person has their sibling tell them to wait as long as possible. Is that right? We'll answer all those questions starting now. Welcome in. Glad to have you. Ben George with John Stillman of Rosewood Wealth Management. John, a little Q&A for you today. You ready to answer some questions? I know you get them all the time, so these are probably nothing new to you, but some pretty common scenarios, I think, that will help out some people.
Yeah, my challenge today will be not get too long-winded on any one question since we have a few of them to hit.
Okay, well, let's get into it right off the bat. Here's a longer question, but let's get into it and then break it down. So I spent most of my career making a fairly steady salary in the low six figures. But since joining a startup at just the right time 4 years ago, I've been making 3 to 4 times as much. I obviously love the new income, but I'm very worried about making the right decisions with this money. I don't want to squander it, but have never been at this income level before, and I don't really know what I'm doing. So what would you recommend for me? All right, John, where do you want to start?
Well, so one thing to understand when you have an income at that level is that tax planning is a whole lot more important for you now than it was back then. Just because you're in a higher bracket, there's a lot more things that you need to be taking advantage of because your marginal tax rate is now so high. So just understand that tax planning needs to be a big part of your conversation. Now, you also said, I don't want to squander this money. It's good that you have that mindset. The thing you have to watch out for is this thing called lifestyle creep. Lifestyle creep is when your income goes up, creeps up, and then your lifestyle creeps right along with it. Now, normally the people that are going to be most susceptible to that are people that are just incrementally getting little raises every so often, and it never feels like a huge amount. And so your lifestyle can more easily creep up to that. If you go from making $100,000 a year to $300,000 a year, it's more unlikely that your lifestyle is just going to triple like that because it feels like a whole lot more money. So you're conscious of the fact that you're making more, and you can right off the bat, once you get to that new income level, go ahead and make better decisions. So be aware of lifestyle creep, but also I think you're probably less susceptible to it than a lot of people are. So what you probably want to do is we know we have enough of a sample size to know that you used to live your life, apparently, probably pretty comfortably on this much income. And now you have this much income. Well, if you can take your lifestyle or keep your lifestyle here, maybe not back there, but maybe more like that. So increase your lifestyle from where you were at your previous income, but don't double it, don't triple it. That gives you the money that you can then put aside so that if something goes awry with this new startup that you're working at, and let's be honest, in a company like that, who knows how long these good days are going to last. So if you can keep your lifestyle where you're accustomed to it being, use that extra income, put it away to give yourself flexibility for the future, that's what's really going to help you out the most.
I guess just asking this question probably means they're ahead of the curve a little bit, right? Because to your point, I mean, a lot of people don't even think about that. Hey, let me enjoy this income bump for a little while, then I'll figure it out. But to be asking this question now, I think is a good position to be in.
Well, I can give you a real life example of this. So we have several clients who work at Epic Games in Cary. So they make Fortnite, the video game Fortnite. If you have kids under 18, like you're probably familiar with that because they've probably played it at some point. So, this company within the last decade just took off in terms of success and revenue and profits, and employees there were suddenly making, they're bringing in bonuses that were 2 and 3 times their salary. So you've got people with a base salary of $100,000 or $115,000, but they're actually making like $350,000 once you factor in their bonuses. And it was really a really interesting case study to see how some people behave with that. Some people are really judicious about like, let me be smart with this. I don't know how long these bonuses are going to last. Let's be productive with this money while it's coming in. And other people just immediately adapted to this richer lifestyle. And, in some cases, the bonuses didn't last and they found themselves in a little bit of trouble. In other cases, they weren't necessarily in trouble, but they did have to cut out a lot of lifestyle things that they'd gotten accustomed to. So we have a real life example of how different people behave differently in this exact situation.
And this is a perfect reason to have a conversation too with a financial planner, right? This is a great starting point and a great way to jump off that relationship.
Yep.
All right, let's jump into question number 2 then, John. This is another one here for people that are worried about doing a little tax planning, but also maybe getting some year-end gifts done before 2026. But here's the question. Help me understand how much money I'm able to give my adult children without incurring any tax issues. I've heard that I can give them $15,000, but I've also heard you can do much more than that if you know what you're doing. So make sure we know what we're doing here, John.
Yeah, well, so first thing, that 15,000 that you're talking about, you're probably working off numbers from a couple of years ago. It's actually now 19,000 is the number as we have this conversation now in 2025. $19,000 per year is the amount that you can give somebody without incurring any gift tax. And by the way, gift tax is paid by the person giving the gift, not the person who receives it. That's a little counterintuitive for some people. The person giving the gift is the one who is taxed. So hypothetically, if I have a kid that I want to give $19,000 to, I can do it. No questions asked. I don't really need to have any sort of reporting related to it. It's just, I can give that $19,000 as a gift with no issue. Now, the reality is if I'm married and the kid I'm giving the gift to is married, I can now give them 4 times as much because I could give 19,000. My wife could give 19,000. So now we're at 38,000. I could give my child's spouse 19,000 and my wife could give my child's spouse 19,000. So each individual can gift 19,000 to each other individual in the equation. So if it's a married couple giving to another married couple, suddenly now it's this much bigger amount that we can give without it being any sort of tax issue. So that's one thing to understand. It's not just the 19,000 if you've got multiple people involved in either side of the transaction. The next thing to understand is the unified estate tax credit, which is essentially, if I died right now with an estate of $5 million, and I'm not talking about retirement accounts because IRAs are going to be taxed when they go to your kids. But if I just had $5 million in a bank account, my heirs are not going to pay taxes on that because it's below the threshold for estate tax at the federal level. So I can, if I want to, let's say I wanted to give $150,000 to a kid now and not pay taxes on it. Basically, I just have to tell the IRS, hey, I am pre-giving some of my estate tax threshold, which now is like 12 million per person. I'm just pre-giving $150,000 of that 12 million. I'm giving it to them now while I'm still alive. So then if I ended up with 12 million at my death, well, a portion of it's going to be taxed because I already gave that 150,000 away tax-free. But if I die with 10 million, still no tax because I'm still under the threshold of what I died with plus what I gave away early, if that makes sense. So there is a way around it. It's basically just a form you have to fill out when you do your taxes to say, hey, I gave this money over and above the gift tax limit, but just understand I'm giving away part of my estate in advance. It sounds more complex than it is. It's not that complicated to do. You just want to make sure you get the paperwork done correctly and that you do get it done, period.
Yeah. Again, another reason why you want to sit down and have a conversation with John. You can do so at rosewoodwealthmanagement.com, learn more about what they do, but also meetwithjohn.com to schedule that time. Again, some bigger planning discussions to be had there, even around this question. All right. One last question for you, John, as we wrap up today's episode. So this one about Social Security, and curious your thoughts on this. So I'm retiring next month at 67 and assume that I just start my Social Security as soon as I get my last paycheck. But my sister says that I should wait until age 70 so I get a bigger amount. Is it actually worth waiting on this?
Well, maybe your sister may be entirely correct. But the thing you have to remember is that even if she's entirely correct for her, that might not necessarily mean that it's the right decision for you. Everybody's math is a little bit different on this. So I'll give you an example. Let's suppose that you have somebody who hasn't really saved much over the years, and they're still working in their mid 60s, late 60s, trying to build up some retirement savings so that they can eventually retire, but they just don't have that much. Well, in their case, the best bet for them is going to be work as long as you can, get as close to age 70 as possible, and start that Social Security benefit as late as you can, because you're going to need that maximum benefit to make the numbers work for you over the course of your life. Now, let's say you're retiring at 65 and you've done a really good job saving for retirement. Well, yes, we could, if we wanted to, put your Social Security off until age 70 and start drawing down on some of your assets in the meantime. And in a lot of cases, we do that. We recommend that to clients. We actually want to get some of the money out of their IRAs, go ahead and pay the taxes on those, but stay in the lower tax bracket, which we can do if we don't have Social Security as part of the taxable income equation. So yeah, there are cases where we'll do that. We'll intentionally put Social Security off, even though you're retired, so that we can get money out of essentially the tax time bomb account that is your IRA. But then there are other cases where we don't want to do that because you don't have so much in the IRA that it's going to be a problem. We don't want to just obliterate your liquid assets for the sole purpose of putting off Social Security until 70. We don't want to leave you with hardly anything investable that's growing and that's liquid and available in bigger chunks, just so we can get that bigger Social Security benefit. So, people are all over the place in terms of what actually makes sense for them on this. I'm not saying your sister's wrong. Again, your sister could very well be right for her, but that not be the right answer for you. Great example of a question that we have to tackle based on your numbers, your lifestyle, the math in your case, not in hers. But great question.
So she's right that you will get a bigger amount. It's just not necessarily correct that it's the best decision for you.
That's right. And also, the other thing is longevity. I mean, if nobody in your family has lived past the age of 75, maybe putting it off as long as possible isn't the best thing for you. Because if you're not going to live that long, you'll get a bigger amount, but you'll get it for less time. And you might have been better off to get that amount or get a lesser amount started earlier and have it for longer.
All right. Great question. Again, another reason to have a financial professional on your side. John is a chartered retirement planning counselor at Rosewood Wealth Management. Happy to talk about these topics and much more. Whatever's on your mind, whatever questions you might have, any concerns, whatever it is, get in touch, meetwithjohn.com. Great questions. Thanks for sending them in. Again, if you have some for us, drop a comment down below or reach out to John directly. We'll be back again in another video coming soon, so please subscribe.
Carolina Wealth Stewards doing business as Rosewood Wealth Management is a registered investment advisor in the state of North Carolina. The material presented is intended to be general information and should not be construed by any consumer as the rendering of personalized investment advice.